Hey everybody, this is Dan, and today I'm back with another mortgage explainer, with the topic being private mortgage insurance, or PMI as it's sometimes called. So what is it? Why do we need it? And how does it work? Okay. So mortgage insurance is required on any conventional loan. We are not putting at least 20% towards the down payment based on the purchase price. The reason that we need to charge the mortgage insurance is because at the beginning of the loan, when your loan balance is the highest compared to what your home value is, that's when there's the most risk for a lender to borrow the money just in case worst case scenario happens in the event of a foreclosure. And if the lender does go through the foreclosure process, and if they're not able to get back the loan amount that was remaining that was owed to them, then that private mortgage insurance company insures the lender, making sure that they're not going to lose the money based on the difference between that sales price and the remaining loan balance. So that's why it's required. But now, private mortgage insurance, or PMI, again, that's with conventional loans. Other loan programs, like government programs such as FHA, VA, and USDA, some of those have their own types of mortgage insurance, but they're not through private companies. They're through the government for offering those types of programs. So that term PMI gets used quite a bit, but basically that pertains to conventional loans or non-government loans. Okay. And there's many things that can affect how much the PMI is and what you're going to be paying in that mortgage insurance. And I wanted to pull this up for everybody too, just so we can see. So just like interest rates, that depending on the situation, the loan amount, credit score, debt ratio, how much you're putting towards the down payment, things like that are going to impact how much the mortgage insurance cost is going to be. Now, in a perfect world, if we can all come up with a 20% or larger down payment, yes, you can avoid having to pay any of the mortgage insurance. But you're not required to put 20% down to purchase a home, even with conventional financing. And again, in that case, there's the charge of the mortgage insurance until you do have enough equity that it can be removed. So again, I wanted to show you some of the different things that impact what the cost of the mortgage insurance it would be. A lot of times, clients are going to choose the option where the mortgage insurance is included in their monthly payment. It's a certain percentage annually, again, based on different factors, that's included in your mortgage payment until you're eligible to remove that mortgage insurance in the future. So there's a few different ways you can do that as well. So again, paying it monthly is most common. There are also options where you can pay a lump sum up front at the time of closing and not have to have mortgage insurance included in your payment, but then you're going to have a lump sum and more money that you're bringing into closing. And then there's the option where you can split it too. You pay a little lump sum up front. It'll give you a slightly reduced cost of mortgage insurance in your payment. So those are the main options that you can look at with the mortgage insurance. And as I mentioned too, it depends on a lot of different factors as far as how much you have to pay in the mortgage insurance. Typically, the more you put down, getting closer to the 20%, so the more equity that you have, the less you're going to have to pay in mortgage insurance. And same with other risk-based factors, such as, the better your credit score is, the lower your premium for your mortgage insurance will be as well. How many borrowers are on the loan? Again, what the debt ratio is, and is it a 30-year mortgage or is it a shorter term like a 20 or a 15-year where you're going to be paying that mortgage down quicker? So a lot of these different things can impact how much you're going to pay in your mortgage insurance. Now, another good thing to note is that most mortgage insurance companies require that you keep that mortgage insurance in place for a minimum of 2 years. Even if you pay an extra amount after closing, if you pay a lump sum 6 months after you take out the loan and you're getting the 20% equity in your home after closing, that's fine. But really, the only way to drop it off early before the 2-year mark is if you do a refinance. Okay, because again, a lot of the mortgage insurance companies say once you have the mortgage insurance on, unless you refinance, most of them are going to require you to keep that on for a minimum of 2 years. Okay. And then after that 2 year mark, if you have the 20% equity, that's when you can reach out to the servicer that you're making the payments to. And again, based on the purchase price of the home, you can request them to remove that mortgage insurance from your payment. Again, as long as you have that 20% equity. Now, if you do not pay attention to when you do have the 20% equity as you're making your payments and reducing your balance, it will not automatically drop off until you reach 78% loan to value. Okay, so there's a little window between 78 and 80% loan to value where it's on us as the consumers to remember, hey, I've got enough equity now, I can request that mortgage insurance to be removed. Because if you forget to do that, then you are not going to have it automatically dropped off your payments until you have that 78% loan to value or 22% equity in your home. Now, I do help my clients keep track of this, and if your home also does increase in value after a couple of years, and you think, hey, based on my new home's expected value, maybe I do have 20% based on my new value, but not based on what I bought the house for. There's usually options where you may be able to order an appraisal to also prove that you now have that 20% equity. So, mortgage insurance, again, with the conventional loans, is going to be required with less than 20% towards that down payment. And there's a lot of things that you would like to know about that. And I'm happy to give a specific quote for anybody, based on their situation. As always, you can contact me here anytime with questions about this or anything else. Thank you again all for stopping by, and I hope you have a great day.